Yeah. They said it was going to be the same as last year.
I think they were always Sundays, just Sundays.
We kind of flipped and flopped Sunday, Saturday. Oh, did you guys were you in Woodbridge and Markham? There's Bubbles?
Am I? Oh.
Put the time.
Hey guys, how's it going?
Good. How'd your board meeting go?
Arguments over how to what to do with the portfolio. That's why it took so long. Sorry. You know how old guys are.
Buy that Kathy Wood.
Nothing wrong with old guys.
Like an amenity room?
They I told them like I made a few suggestions on what to do during bear markets, but they just want to like hold on to everything and just weather it out.
Hey, can we talk about this later?
Like dividends.
I'm sending the email out now.
What?
I'm sending the email out now.
Okay.
All right, so yeah. How many do we have here? 21. I'll just give it a few more minutes and then I'll start it. Just going to share my screen. Can you guys see my screen?
Yep.
All good.
All right. You guys have questions, just speak up because I don't read the chat that much. Right. So did everybody got a chance to use the algorithm? So like over the weekend, I kind of give like a brief explanation of how the indicator work. So just going to go over it a little bit again. So basically, it's pretty simple. The algorithm works best if you know a little bit about the technicals. Then you can combine using your technical setups, and then kind of just use the algorithm as confirmation for the what you see as a setup itself. I find it work best like when I'm looking at a setup that I want to go into, and then I just kind of look over and see what the algorithm is doing, and then it kind of helps me confirm the move that I wanted to do. But if you're not good with technicals, you can actually just use this and just use the buy and sell signals to trade off of it. But there are some rules that should go with it, because obviously it works really well when it's trending, and it works well when it's in the wide range. But when it's in like a very tight range, like it did all afternoon today, that's when you kind of want to ignore the algorithm signals and kind of just go with just not trade with it, right? So how it works is the trend right here, the line is where your stop loss is, right? So whenever it crosses the line, it stops you out of the trade, so it gives you that sell signal. This works best with Heiken Ashi bars. It kind of smooths it out so that it doesn't trigger false signals as much. So it does create like a lot better indicate buy sell signal based off the Heikin-Ashi bars, right? Because it's calculated for the previous 6 bars into the candle, so that if it's still working in the range of the upper range, it stays green, right? And if it doesn't work in upper range and start changing, that the candles tend to shrink like it does right here. It shrinks before it turns, and then it changes colors, right? So it kind of gives you a hint that there's a reverse that's about to come. Right now, if you combine that with these pressure bands, so the pressure bands, what they do is they measure the intensity of the move, right? It's almost like measuring the volatility, except for it creates 3 different tiers of pressure. So when it's very high pressure, if the candles break outside of the bands, you kind of get these little flags right here that tells you it's been outside of the flag. So usually when it travels outside the flag, the candles, it tend to revert back into the mean like it does right here. So it started the move and it started off with like a aggressive push up, and then it just kind of pulls back into the mean. So what you can do with this is, if you sell credit spreads, this is a good way to use to sell credit spreads. When they go outside of the bands and they start reverting back into the mean, you can actually sell credit spreads, and then as it revert back into mean, you can profit off the decay on something like that, right? And another way is to just use the bands as a way to take profits. So whenever it goes outside the band, what you're looking for is to get some kind of indication that will revert him back into the mean. So to do that, you'll see something like this where it pushes up with these big candles, and all of a sudden the Heikin-Ashi candle starts shrinking to these little dojis. That's when you know that the momentum is slowing down, and that you can either take a full exit, or you can just trim and take partial profits and to see if it continues higher once it reverts back into the mean, right? So that's the way that I tend to use it. And whenever it goes parabolic like this, right, it tends to flatten out. Sometimes if you see like a flatten out of the bands starts flatten out, that usually means that it's hit its peak and it start going back into the mean. So if you do see like the band start flattening out, you kind of know that potentially that's the bottom, like it did right here. It went expanded and then start flattening out, right? Once you start flattening out, you see that it actually consolidates before it makes the next move, right? So you kind of realize that once the big move is done, it starts flattening out. That means it's going to be in a consolidation. So if you're trading with options, you want to take profits. If you're trading with shares, you want to move up your stops. That way you're locking your profits in, right? So that's a good way to use the pressure band. Also, when the pressure bands contract like this, that means it's in a squeeze, meaning potentially there's a expansion of volatility, and then you can use that as a guidance which way it's going to go to. It's going to be a bigger than expected move once it tightens up really tight, right? So, especially when all 3 of the of the zones goes inside. The space just a little bit like it is right here where he's squeezing like the upper and the lower part of the candle. It's getting super tight. That's when you know that sometimes when it goes like that, a big move is about to happen, like it did right here, right? So it gets into like the upper and lower part of the candle. We just get squeezed together, and then you get the big expansion right afterwards, right?
Eddie, question for you.
Yeah.
So where you're showing, if you look at your text there, yellow circles are higher probability. Just before that, where you're showing the bands and the triangles above the bands there that are kind of signaling, you're saying it almost signals that reversal back to the downside. Have you seen this work with your bands for an up move? Because it looks to me, just based on that price action of that day, you're only getting those indicators showing up outside the bands to signal potential down move, as opposed to seeing an up move.
Okay, you're talking about the flags?
Yeah, the flag. Sorry.
Yeah, the
The flags. Yeah, they all seem to be more so directed to showing you a downside move rather than showing you anything that would go for an upside move.
Yeah, so the
You know,
flags
like-
usually means when the volatility gets really big. So it makes a bigger than expected move. So it shoots outside of the bands. And then what happens when it shoots outside the bands, it kind of reverts back into the bands. And then you'll continue higher. But what you want to see when you start going outside the bands, because we're expanding, you want to start seeing the price moves to start going flat. Once you start going flat after being outside the bands, like right here, then it reverts back into the mean. So what I normally go for is once, let me show you a real chart. Okay. So once it goes outside of the bands like this, you want to see what the bands are doing. So when it's steep up like this and start going outside band, it just means that it's a very big move. It's a parabolic move. So once you hit a parabolic move, there's a few ways to trade that, right? You leave it go parabolic. You want to see how far away it is from the 8-day moving average. So that's why you want to use in conjunction with this, actual chart with all the proper technicals with the moving averages and everything on another chart. So you can actually see the candles actually expanding past extended from the 8, and then once you start seeing the band start flatten out, then you know that the volatility actually start decreasing, and then a potential pullback or consolidation after the big parabolic move. So all this is just and because we're using Heikin-Ashis, the candles go outside a little bit, but if you look at the candles, if you turn that into candles, oops. Right, so you can see the actual candles form. So when it goes outside, the candles are going outside of the things. As it expands, it just means that it's a very big parabolic move. And once it goes outside, it reverts back. And then as you see that once it reverts back into the bands start flattening out a little bit, like the bottom and the top start flattening out. You see that you'll start consolidating after that. So normally what I do is once I start seeing it expand out, I'm looking for clues to see if it's actually going to revert back to the mean, right? Usually you'll get like a reversal, like a candle or a change in color, or the ribbons start rolling over. Right, that gives you more of a confirmation that the volatility is slowing down, the momentum is slowing down, and that it potentially could reverse back onto you. So I use this to ride it up, and then I use this as a indication that I should start taking profits a little bit early before the actual signal happens. So these little indicators right here and these ones with the different arrows are early indications. The yellow bars are turning points, and then sometimes you get like a yellow dot. A yellow dot is a more higher potential turning point because it uses a different combination of equations to calculate the distance, the volume, the distance of the candles, and how the candles is moving within the bar to give you these yellow bars right here. So usually it's like it's breaking the low of the previous candle, or with volume. That's when it start turning yellow on you. So it's basically just hinting you that the momentum is slowing down. It doesn't always reverse, but it just tells you that it's a hint that it potentially could reverse on you, and then you should be taking some profits. You don't have to go fully exit, but I would take some profits once it turns yellow, right? Because it can revert back down, or it just consolidates and then continues higher, right? So all the yellow does is just telling you a potential reversal point. So normally how I trade it, if I'm scalping, I take the full exit. If I'm trying to follow the trend, what I'm trying to do is if there's yellow, I'm waiting for the confirmation, which is the sell signal, right? So if I actually bought, I'm actually waiting for the sell signal to confirm the move is actually reverse on me if I am going to follow the entire trend. But normally I don't follow the entire trend. I ride it till I see the yellow candle, and then I trim some, and I'll see if it's going to start rolling over or not. I use the ribbons to confirm the rollover, because as you can see right here, if I zoom in, you see that once the momentum rises, the ribbon expands, and once it starts contracting is when you start rolling over or consolidate. So once I see that, and then I see a yellow candle somewhere along there, or a yellow dot, then that's the area that I'm going to take my profit. Mhm. Go back to the slide there. Right. And these arrows, like these triangle arrows, they're measuring like the RSI overbought or oversold areas. So it can stay overbought, oversold for a little while. So that just gives you kind of like an early hint that there's something that's changing with the momentum. And then all you're waiting for is the yellow candle, the yellow dot, and then or confirmation signal, which gives you the buy or sell to confirm the potential reversal, right? So as you see right here, it was flushing down, and then all of a sudden you get these arrows at the bottom start shooting back up. That tells you that like the momentum actually stopped, and then potentially it's going to reverse pretty soon. And then as you can see, you get the yellow candles, you see the ribbons start curving back up, and then you finally get the buy signal, right? And then all you have to do after you get a buy signal is that you just follow the trend up. You can actually follow it all the way up to here before you sell when the ribbons start rolling over, or the yellow candles start happening, or you can even take the early exit once you see these triangles start showing red triangles on the top of the end of the move, right? Those are all just like early indications, and then of momentum stopping. And then, like I said, sometimes it just kind of consolidates into a moving average, and then it continues higher. And then finally you get the reversal sell signal once it breaks like a certain range within the last 5 or 6 candles. So because these last 5 or 6 candles been pretty small, this one candle triggers the sell order, right? But if, say, the candles were still pretty big and just consolidating, it would not trigger the sell signal just yet. But it gives you early indication that it was going to start rolling over or consolidate. Right. So I kind of, try to develop a system to trade around that. So normally I buy during the green, and then I just sell once you start rolling over. But if you're pattern trading, you just kind of hold till you get the confirmation. And then you can actually just trim instead of sell the whole thing if you don't get like a confirmation sell order, right? So like if I was riding this, I bought right here, I would trim at the yellow candle right here, and then as it pulls back into the moving average and start bouncing again, once it gets up here and you start seeing the arrows with a higher high, you can trim once again, and then once you get the confirmation, you could get out of the whole position, right? So that's one of the ways that you can trade with it, especially with the 5-minute candle. The 5-minute time frame. The 5-minute time frame actually captured the biggest moves. So if you want to just avoid the noise and just follow the entire 5-minute trend, then you can make quite a bit of money on those big trending days. Like the last 3 days, you would have made a lot of money just buying the opening trend on the way up, right? So like today, you got the early indication in pre-market, and I've seen this in pre-market. So I use a combination of technicals as well as this buy signal. So with the pre-market, I seen like a very tight range, and then I seen it start breaking above the range in a squeeze. So when that happened, I see a buy signal. I knew that we were going to lead into the open, because the futures were fairly green, and then we had some earnings coming up before the open. So I think people were anticipating earnings from Bank of America and Charles Schwab. So it did make a push up, and there was some news with the UK or whatever pre-market too. So it kind of just triggered this short squeeze, and then you ride the way up. And I traded like pre-market, and then even at the open, we just picked up the momentum and we continue higher, right? So if you've seen this pre-market and then at the open you didn't get a sell signal, you can actually buy that and just set a stop at the low of the consolidation, and then just ride the rest of the way up, right? So that's kind of what I did today. I kind of ride it up, and then I sold a little bit early. I sold it like around right here, and then a little bit more over here, and then I was out a little bit too early. So, but some of you guys like today, I know you guys like stay till the sell signal, and you guys make quite a bit of money just playing that opening 30 minutes there. And you almost double your money in the opening 30 minutes. That could be your only trade of the day, and make enough for the day because it was a fairly good move, right?
So I see you're on the 2 minute there.
Yeah, this is the 2 minute.
Yeah, I've noticed, like, I've put up 1 minute, 3 minute, 5 minute, and I don't know what everybody else is seeing, but I feel like the 3 minute is the most accurate on the anticipation of the next move, whereas 1 minute can just fake you out, and 5 minutes is just a little bit too slow.
Yeah,
So
so
the three seems to kind of dial in between the two of them and give you a little bit more accuracy in what's coming next. I don't know, just my take.
yeah, so it really depends on your trading style, right? So where I'm actually scalping, I'm using 1 minute because I'm scalping small ranges, right? So 1 minute works for me. 2 minute actually works really well if you're looking for in between. So like you say, you use the 3 minute, which is about the same as two and three is about the same for the medium range, right? But what I do is I use the 5 minute to guide me as the entire trend. And then I scalp the trend. So if the trend is bullish, I am only looking for bullish trades within the algorithm, right? So I'm looking at here. I'm going to do a split screen, right? So I won't have the 5 minute over here, and then I'll have the 1 minute on this side, right? Right. So here on the 1 minute, you have the trigger of the buy signal right before the open. But if you look in the 5 minute, right, it was like way before. It was like over here. When that happened, you got the buy signal over here, right? So when I see the buy signal on the 5 minute trending up, I'm using the 1 minute to scalp within that trend. So I did this one right here, the buy right here, and then there was a sell signal right here, but I sold right here on the yellow dot. So I traded this, and then I made a second trade, like from when I seen it not fall and I see the green arrow again, I traded from here to here again, right? And then at the open, I made this trade right here at the open because I got a buy signal literally right before the open. So I kind of waited till the open to see if we break the low of this buy signal. Right, it didn't break below, so I went in. It did start moving already, and I went in after the move. But I knew that because at the open, it kind of picks up momentum if you're in the right direction, because the 5 minute was in a very strong trend. I used the 1 minute to enter, and then as soon as I start seeing these little arrows up top, I start trimming over here, and then trim till I was fully out, right? But you normally, if you got in right here, you would wait for the like the red dots, because this is a parabolic move. Once you start seeing the arrows start coming through at the upper range, and then you see that we finally start curving up on the pressure bands. That means momentum slowing down. That's usually where you want to take the exit, especially at the open, right? Because open, if you remember in the course, I talked about different time frames during the open, and where the reversal points tends to be is at the first 30 minutes. So after the first 30 minutes, it tends to reverse in the other direction normally. So it usually goes up like this, hits like a resistance, and then just going to flush right down, right? So that's why I kind of took like an early exit, because I was afraid that we were going to get that flush right down right at the open, because the first 30 minutes, it's really, really fast. You make the most amount of money in the right direction, but you also can lose your money quite fast in the first 30 minutes, right? That's why you want to wait about 10 minutes if you're new and you don't know what's going on. You kind of want to wait like 10-15 minutes to see a direction or a range, and then you trade the breakout range. Unfortunately, today we didn't have a breakout range to trade with, and it just kind of choke off right from the open. So yeah, if I show the candle, if I turn this into a candle, right? So if you turn on your candle, you'll see that right here is where you ride, and then you get the yellow dots, and then you get the arrows coming through with the flat band, and then the ribbon rolling over. So that was a pretty clear signal to exit your trade. We're over here, and you're really not trying to short when the 5 minute is in a buy trend, right? Because when it's in a buy trend, you don't really want to counter trend. You want to trade with the trend. That's your highest probability trade. I mean, if it's overextended and you want to scalp it back to the mean, you can do it, but it requires a certain skill set to do that, right? So you try not to play the reversal onto an uptrend. You're basically just buying and then you're selling the uptrend, and then you wait for another buy signal to go in and then sell the uptrend again, right? Until you start getting the 5 minute sell signal, and that's when you could try to trade a reversion to the mean, which means you'll go back to the moving averages or go back to a support level, and you can actually scalp that down if you wanted to. But if you want a higher probability trade, you really want to just follow the 5 minute trend and then trade the 5 minute trend. If you want to scalp, like I said, you want to use the 1 or 2 minute candle when you're scalping the trend. If you just want to, one of those people that just want to buy and hold the entire trend, just use the 5 minutes. If you hold the 5 minutes, on most days, if we're just going to go one direction, if you know how to read internals and it's a trending day, that's the day that you just kind of watch the 5 minute and just kind of stay in there till it gives you the signals to get out. That's how you could capture a really big move, right? Because I did that on was it on Friday, where I don't normally trade that much on Friday because I can't keep an eye on it. So I kind of just buy it and kind of test out the theory that what happens if I just hold instead of just keep trying to go in and out of the trend. And like I was using less contracts, like 3 times less than my average, and I was making 3 times more money because I was actually capturing the entire trend because I knew it was a trending day with the strong internals, right? So plus if you follow the Heiken Ashley bars, you can see that the candles were really strong all the way up on yesterday, all the way down. I mean, yeah, you see how big the candles are. So that's what you do. You use the 5 minutes to guide you, and then you use the smaller time frames to really trade off of it if you really want to trade off of it. Otherwise, if you don't want the noise, then don't trade the 1 minute because it's meant for scalping. If you want to like have a better trend, then you can use the 2 minutes. It actually gives you a pretty good trend to trade with using the 2 minutes alone. It's a little bit better than 1 minute because the 1 minute has a lot of noise, especially in a very choppy environment. So if you use the 2 minute, you actually could have captured this move from the open right here all the way up to the second peak before you get this sell signal, right? And then throughout the day, you like this would have been a fairly good move. It's once you get into the afternoon, so that's one of the rules. Once you get into the afternoon, that's when you really don't want to use the indicators anymore, because in the afternoons it tends to consolidate, and that's when this does not work really well, is when it consolidates into a very tight range. So once you see a tight range, you don't want to trade those tight ranges with the indicator, right? So
Hey, Eddie, would you use the indicator maybe in power hour though?
oh yes, power hour is fine, because power hour usually in the last hour a trend is developed already, unless it's like today where it's still in a very tight range. Then it's no good. You want to see a break of the range. That's where a combination of candlestick patterns as well as the algo will make it work way better, because if you know your technicals, in a consolidation, we have a squeeze play where it consolidates and then it breaks one direction or the other, and then you play the break, right? So
Okay.
if it breaks and then it triggers a buy signal on the break, then you know that would be a fairly good entry point, right?
Great, thanks.
Yeah, so these are just some of the rules that we already talked about. Like, you only trade direction of the trend. Counter trend trades, like you can do it, but you have to be good at it, and they're lower probability and higher risk, obviously, right? So the least resistance is actually just go with the 5-minute trend and just scalp the trend on the way up if you really want to trade that way. So the buy and sells are confirmation candles, meaning that they were in an uptrend and then it broke, right? That's how you get the buy or the sell signal. Is when it's in a downtrend, it breaks, you get the buy signal. When it's in the uptrend and it breaks, you get the sell signal. It doesn't actually tell you, it doesn't actually mean sell means to sell. Sell just means that you can short it if it's in a downtrend. You use it to sell when it's in the uptrend, right? So selling just means that it's in that direction to start the move. So if you're trading the downside, sell is actually your buy signal for puts, right? If you're in the upside, sell is actually just getting rid of your shares or your position, right? So it works both ways that way. So the arrows, the yellow dots are early indications of reversals. The ribbon actually measures the momentum. So normally I like to trade momentum. So once the ribbons start rolling over, you know that the momentum is actually start slowing down, and it tends to reverse once it slows down. It either consolidates. So if it's a strong uptrend, you'll consolidate into a moving average, and then you'll continue higher. But if it's like a very strong trend and then it start hitting a strong resistance and it reverts, it sometimes can give up all the gains. So usually when you start rolling over, the momentum rolling over, I tend to take my exit. But you can actually stay in there if you wanted to and wait for the confirmation if you want to stay in the trend longer. All right. So I was talking about earlier, the pressure bands actually just tell you extremes of a move. So if it hits outside the bands, it tends to go back into the mean, which is the 21-day moving average. That's what I use for calculation for the mean for the bands. So if it goes too far outside of the mean, it'll revert back into the 21. And then if it holds, it'll continue higher. If it doesn't, it's going to break down, right? So that's basically what I use it for. I use it as like an exit strategy, or I use it as an entry on for reversing to the mean play, right? So if it gets too extended away from the 21 and the 8 and it's outside the bands, I could actually sell say a call credit spread, and then as you revert back to the 21, I can close my credit spread for a play, right?
Andy, can you go back to the chart and just point out the pressure bands?
Yeah. Yeah, so these ones right here.
Yeah, okay.
Yeah, so as you see, like sometimes the candles go right out, like let's see, you'll look better on the actual candles right here. So you see where it goes push like outside of the last layer of the bands. That requires a big move in order to do that, big momentum to push it. So once it's outside, it tends to revert back into the trend, right? So if you start hitting the outside, you can sell like an money band call spread, and then once you start reverting back into the mean, like you could use the sell signal as your confirmation, but once you start reverting out, you can you can go back, and then once you start coming back to the mean, your out of money spread should actually decay a little bit, and then you can actually close off for a quick little profit. Or you can just just trade that direction too if you wanted to for a play. So it really depends what you trade with. Some of you sell credit spreads, some of you do futures, some of you do shares, some do options. Like this type of play, reversion to a mean, is really good for selling spreads, right? Because the reversion back to mean is not like a really big move, but sometimes you'll do this. It takes a long time to revert back to the mean because it's a momentum move, and then it's consolidating, right? So if you're just buying a put, it's not going to make you money, because if it's just consolidating, theta is actually working against you. But if you sell a credit spread, that time that you consolidate is actually going to make you money. So that's why I tend to use this more just for either a quick exit or to play version to mean, which is selling a credit spread to profit off the decay. So especially when you're hitting into the afternoon, like in the afternoon is really good for that, because once it passes the first 2 hours, from that time till power hour, tend to go sideways, or move very, very slowly. And that's when theta really works in favor. So if you want to use like do some credit spreads, look for like an expansion move away from the 8. And then as we hit into those afternoon lunch hours, that's when you know that, you know, you can drift like throughout the afternoon and you can profit off that. So you can use that as like an entry point for selling the credit spread.
So to simplify things a little bit, up to let's say 11 o'clock, you would try and determine the morning trend and then follow the buy signal.
Mhm.
And then let's say after 11, when things slow down and things are consolidation, then you really look for the sell signal where the candle crosses over past the pressure band. And once the sell signal is activated, look at potentially selling credit spreads.
Yes, that's right. You can also do shares too. So you can actually do shares and just set a stop. Anything with a physical stop you can do in the afternoons. The only thing that you can't do in the afternoons, and I've done this for so long that I know that in the afternoons is where I tend to screw up a lot, get fake out a lot, and lose a lot of money. Trading options it's because it's in the afternoon. All the algos start hunting your stops in the afternoons, right? So it's not good for buying options, but it's pretty good for selling options. And sometimes there's still trends within the afternoon, so you can still trade them if there's a range that you can trade. And to do that, if you want to trade the range, it's actually best to just go with shares or go with futures. If you want to trade directionally instead of a credit spread.
Okay.
Yeah. If you guys are selling credit spreads, like there's a few times out of the day that is best for credit spreads, and I think 12:30 is one of them. 12:30, 2:30, and I think like 3:30. Like these 3 time frames are fairly good for selling spreads. Yeah. Right. So I was saying you want to use only 1 or 2 minutes to scalp this smaller trends. So if you're a scalper, that's the time frame you want to use. And then you trade it in with the 5-minute trend, right? So if we're in an uptrend, you're looking for bullish setups. And then if you get a sell signal during that time, you're basically just selling. You're not shorting, right? Because once you still start shorting while in the 5-minute uptrend, you're basically betting against the trend, and that's the less probability way to trade. So even if you think it's overextended, it could just pull back a little bit and then actually keep on going higher, right? Because the 5-minute trend is still strong. There's really no point to try to short it, right? Even though you think that it's going to come back down. And I tried that a few times and it didn't work out that well, right? Because I was trying to go against the trend. So your odds are not in your favor. And if you want to make money, like easy money, you always want to just trade with the trend, right? And in the best trades, it's the first 2 hours, obviously, because that's where majority of the moves are being made, and that's where majority of the volume is as well. And if you're trading with options, you definitely need fast moving and volume to trade with options, right? And that's when you want to have a trading plan for the opening. Like I like to trade open range breakouts. And I like to trade the momentum, continuation momentum off the pre-market levels as well. So like today, we talked about being the trend was already being established pre-market, and then at the open just made a continuation move, right? So if I seen pre-market was steadily trending up, I wait for the open candle to see which direction we're going, and then you want to see if you'll break the low of the pre-market candle. If it doesn't break the low of the pre-market candle and it breaks the high of the pre-market candle, you want to see where's the resistance point, right? So that's why it's important. Like in the course, we talked about the different levels before the market opens. So if there's a level before market open that's a heavy resistance, we're going to use that as a potential area where it could reverse on you, and also an area where you use as a target, even though like sometimes like the first 30 minutes, even though like the trend is very strong, you can hit those resistance points and make a very sharp reversal, and it's very quick. It's just like that, and all your profits are gone. So that's why if you're going to trade the first 30 minutes, you have to be quick on your exit. You want to take some profits as you start hitting into some of these resistance points. You never want to leave a full position on hitting into a resistance point right at the open, because you get a lot of those sharp reversals at the open, especially when you gap up at the open, right? You gap up, you hit that resistance, and then it fills the gap just like yesterday. So those are the type of scenarios that can happen right at the open. So you want to give it some time and actually have a trading plan and know where your levels are. That really helps with the trading. But if you use the 1 minute time frame, once that reversal happens, you'll see the sell signal right away. But on the 5 minute, it will not appear, or will not. You won't know for certain till the candle actually closes, and 5 minutes is a long time. That's why you have to use a smaller time frame to work with seeing that trend as well. So that 5 minute trend. So you want to always trade the 5 minute trend and use the 1 minute as an early indication of what's going to happen within that 5 minute trend. Like I said, you want to avoid consolidations signal. So if it's in a consolidation and the range is not big enough, so if it's under 15 points on the SPX, it's not worth trading, because from experience, under 15 points with the SPX, you tend to lose money. You can scalp, like if you're really quick, you can scalp the $1 or $2 move, but majority of the time you'll lose money in that consolidation. And with that, it's a very low probability trade. But if you, like today, I draw out the triangle and I knew that that's the upper range, this is the lower range, and I buy the lower range and trade the upper range and get a derivative on the upper range for $1 or $2. That's the type of play I do during the consolidation. But it's with the algo, it doesn't give you enough room to have the buy sell signals if it's under 15 points, right? Because there's very little movement in between, and if you're doing with options, you'll lose money. If you're doing with shares, it'll be easier. You can set a physical stop. After your entry, you can use a 1 candle stop in those tight ranges, and you could make it work. You can scalp like 10 cents or 20 cents in that type of trade if you wanted to. But like majority of the time, you just kind of want to avoid the range trades. So how you can define a range trade right off the bat, how you can figure it out right away, is when you get higher lows, but you also get lower highs. So show you what I mean. So go back to one chart. See more clear on here. So like right here, right? We went up in a trend. So we got the high right here. We got the low right here. We got a lower high, and then somewhat of a higher low right here, and then a lower high, and then a higher low. So if you draw that out, right, it becomes like a triangle, right? So it becomes somewhat like a triangle trade. And basically, when you see something like this, you just want to trade the break. So if it breaks above this trend line is when you really want to trade it. But like today, even though we broke out, it kind of just flopped around for a while because we already hit like a really high target for the day. So I use one ATR to measure the range for a day's move. So this is the Qs. So for the SPY, a 1 day move today was, for SPX, the 1 day was about 96 points, the ATR. And today we were up over 100 points. So we were past the 1 ATR mark. and it's really hard to break out from one ATR and get extended to say 1.5 or 2 ATR in a single day. So the breakout, even though we've broken out of that consolidation, it wasn't a very big move. It just kind of hit the upper resistance over and over again today. So that opening high, that high right here was the key resistance right there. You just keep hitting it, and keep it rejected. So every single time you rally into this area, I took profits. Right. And then I set an alert above it. So if you actually went above it, I would have bought it back, but it didn't go above. It just kind of hit it, came back down, hit it, came back down. So there was really not much to trade. That's why it was a really boring afternoon, because there's literally nothing to do. And the range was just way too small. And there's too much risk to go into a small range like this, right? So if you look at that on SPY, that's about $2, not even $2. So on the SPX is about $15-20, right? So it wasn't like the best range that you can trade with. That's why I just kind of avoid trading like today in the afternoon. I didn't do a whole lot. I did a few trades. I think I got faked out a few times in the afternoon for that range, because it was just way too small. Every time it broken out, it failed right there. So the first fail, I kind of figured it out, and then the second time we tried again, I knew that it was going to fail again. So that's where I tend to take my profit, and I kind of just scalped that $1 instead. So. So use this if you know how to use technicals, right? Use support resistance areas for signals and reversals, right? So these are really high probability trades. So like I said, if you bought at support and you get a buy signal around support, that's a really good buy. So if the algo says buy and it's at support and the technicals are good at the same area, then that's a very high conviction trade. So you go in at that area and then you just wait till the sell signal. And if it hits a resistance before the sell signal comes up, or before a reversal indicator comes up, you can always take some profits, right? You scale out and then you let the rest of it ride, right? So if you get a sell signal and there's still a lot of run room before the next resistance, sometimes it's just it just gives you a sell signal before the consolidation and then the continuation afterwards, right? So if you know how to use that technical measurement from extended move and then a pullback, right? Usually pulls back around 50% of the move. If it gets a buy signal around that 50% mark, that's another buy entry, right? So those are more higher conviction type of trades if you combine support and resistance into your signals as well. So it does help when you know technicals, but if you don't know technicals, you can still just follow the trend as long as you have these rules in place, and you can still make money off trading with just the buy and sell signals, right? As long as you know how to avoid like consolidations, then you're fine, because you usually have a trending market right at the open. If the market opens in a range, like in a tight range, it tends to break out of that range after. So on the breakout is where you want to look for that buy or sell signal on the breakout, and then you can ride that trend, right? So the only thing you want to do is avoid those very small consolidations that's under 15 points on the SPX. That's the only time you don't want to trade anything is around that time.
Hey Eddie, do you use the the bull and bear trend line on your indicator? There's I see like there's a
Oh, that's just a
green line or-
divergence. That's like a divergence indicator, that's all. So it just tells you like sometimes it's in a bearish divergence or bullish divergence.
like you see like the green line below the ribbon or the red line above the ribbon. That's the line I'm talking about.
Oh, you mean this?
Yeah, like the bull trend or the bear trend. Like, is that something of like, do you use that to help you with anything?
Yeah, so this is more for like a stop loss. So this line's more used for stop loss. The ribbons is the momentum lines. So normally I like to ride the momentum, and once the momentum is done, I tend to take my exits. So I kind of use the ribbon to ride the trend up, and then once I start seeing the ribbon start rolling, that's when I start taking my exits. Instead of sometimes if the ribbon rolls right around a sell signal, that's a higher conviction exit, right? But sometimes like the ribbon rolls and then it just continues, like right here, it rolls and then you come back and then it just continues higher, right? So if you know like a little bit on technicals, you can pre-roll measure like the overextension and then the retracement back to like a 50% line, and then it just turns back, reverse back up, right? So like right here, it went up parabolic, and then all it needs was a little breather before a continuation move, right? So, but still, if you bought right here and then you see the rollover, you take the exit and then you just wait till you get the buy signal again to go back in if you really want to trade it. So, and like I said, you want to use the 5 minutes to give you a better indication of where it's going, and then you want to use your 1 minute to really kind of sculpt that in a way. So if I split that, oops. So if you split screen and then you have the 1 minute, and then you have the 5 minute right here. So like right here, go back that far. Right. So like right here, you'll see that we get the buy signal right over here when we got the momentum down, and then you can see that once the top, so with the Heiken Ashi, once the tops start getting dojis, it means that it potentially could reverse soon. So once you see something like this and you get like these big dojis around a key support, so I think this was the 50% retracement area, right? So you start seeing the dojis, and on the 1 minute time frame, you see that it was starting to flatten out, and then all you're waiting for is the yellow candles to give you early indication and the buy signal after that. So whenever I see like it start pulling down, and then I start seeing some yellow candles at a key area, that key potential reversal area, then that tells me that's a much higher conviction buy than say randomly at a chart getting a signal, right? So if you know like moves tends to go up and then pull back 50%, then at the 50% mark you get the buy signal, then I'm definitely going to go in for that trade and just set my stop a little bit lower on. So
Okay, yeah, cool. Yeah, I'm just looking at the different indicators to see if I can turn off some of the lines, right, to make it a little bit easier to.
yeah, so if you want, you can turn off that line, like you can turn off that line if you don't need the stop. I use it for my stop loss if I'm using shares. All I do is I drag my chart trader thing. I kind of drag it to where the line is. So if you're trading shares, it's actually pretty helpful because you know exactly where to drag it to. So if that say you could go here and see what level it is, you can actually drag that onto your chart trader, and that would be a proper stop loss to use.
Okay, cool, thanks.
Yeah, but you can turn that off. That's just I'll show you how to do that. So on here, you just want to go into the
yeah, it was the uptrend and
uptrend and downtrend. Yeah, uptrend and downtrend. Yeah. Once you take that off, then all you see is the momentum ribbon, which is really good because if you're looking for like short-term trades and not like pattern trading, then these ribbons work really well because they're much faster to take your exits, right? Because you can see that it's very close, hugging to the price. So as soon as the price start going into the ribbon, it tends to reverse. So you know exactly the point where momentum is slowing down is when the price actually goes into the ribbon, right? So that's what I use it for, is to have the ribbon, so that once the entire bar goes into ribbon, I know that there's potentially a rollover pretty soon, right? And then I just take my exit, because especially with options, like with shares it's not too bad, but with options, that move from here to like before you get the sell signal is quite a bit of profits you're giving up. It's probably like $3 or $4 right here on that pullback, right? So it could be a pretty big profit to give back if you're holding on to the whole thing. So whenever I see that, I tend to take like at least half of it off, if not 2/3 of it off, and then I'll see if the last little bit would stay. If not, then I take the rest of it off for smaller profit. It's actually not that complicated to use. It's just that there's set of rules that if you want to make money with it and be more consistent with it, that's the only rules. It's in the slides. You want to avoid the afternoons. You want to avoid the consolidations. You only want to scalp the 1 or 2 minute with the 5-minute trend. That's pretty much it, right? Other than that, it's a pretty easy system to follow, easy system to use. Yeah. And if you back test it, all you have to do is go back a few days. Just look at the buy sell signals with that time frame, and you'll see what works best for you, right? I find that for me, the 1 minute works really good for me. The 2 minute lets you stay in a little bit longer, but it also gives you more room to get back some profits as well. But you capture bigger profits if you actually continues higher. So, you know, just like every system, whichever suits your personal needs, right? I much prefer trading the 1 minute because I like the quick exits, and I'm not looking for like a home run every single trade. I'm more looking for my $1 to $5 scalp, right? So, and I do a lot of them. So, you know, that's how I profit. But I mean, some people, they don't want to make that many trades. They just want to, you know, hold the one trend. So then they just use the 5 minutes, just buy right here and they sell right here and they make a lot of money and they're done for the day, right? So, you know, if you caught that move today, that's a really good move. Just say you bought right here, you got a sell signal right there. That's $5. So on SPX, that's 50 points. You know, 50 points if you bought at the money, you know, that's almost like $30, $40 in profit from premium. So, you know, that's a day maker right there. So if that's all you're looking for, then, you know, the opening 2 hours is your best trades for trends, and then the rest of it you can scalp. If the range is good, you can scalp. Like I think I scalped like the afternoon. I think it was I don't know, it was Friday or Thursday. I think it was Thursday that I kind of scalped the whole afternoon because there was a range that I can scalp with. Yeah, so yeah, this is Thursday. So I was going with the 5-minute trend, which was up, right? So I was only looking for bullish trades on the scalps. So I'd be looking for like these, like buy right here, I sell right here, I buy right here, I sell right here, I buy I buy right here, I would trim right here, and then if right here, if I seen the breakout, I would buy right here, and then, you know, you can scale out as you see the yellow candles. You buy, scale out, right? Buy right here, scale right here. So as long as you just follow the trend, you're making money, right? Because these sell signals, you're not shorting, so you're missing all of these false signals, which is these small little consolidations. That's why you don't trade these, right? You don't counter trend because they could be just consolidations. But if you just follow the trend, then, you know, you get the bigger moves with the trend, right? So here you got a little fake out right here, but you would have made so much money off these moves that the few times that you get faked out, you're not losing that much of your profits. If you caught just like this one move right here, you made it all. You made back like 3 or 4 different stops, right? So, you know, that's why, you know, you always want to just scalp with the trend and avoid the other signals to avoid the short signals when they come up, and then you should be able to still make money with just scalping. So.
Hey Eddie,
Mhm.
I noticed today that when the buy or the sell signals come up, sometimes they come up and they disappear right away. Is there a reason behind that, or?
Yeah, it's waiting for the candle to close to confirm.
Okay, so we should definitely wait for the candle to close and then get into the trade.
Yeah, so if you get a flash signal on the 5-minute, use the 1 minute time frame to see if you get that signal as well.
Gotcha. Okay.
Right, because the 1 minute will close before the 5 minute will. So,
Exactly. Yeah. Oh, makes sense. Thank you.
so like that's how I always trade, is use the bigger time frames. I use the bigger time frames to guide me through which direction to trade with, and then I use the smaller time frame to trade within that big time frame trend. So, and that works really well. That's why like my win rate is usually higher, because I mostly just do that. If you're trading with the trend, the resistance is not going against you, right? You're going with the trend, which means the buyers are pushing up, so you're following the money. Versus counter trading, where if you try to counter trade thinking it's too high, and then it just pulls back a little bit and it just continues higher, right? And then you end up losing money. So that I used to do a lot of those trades, and you get caught in a few of them, and then you give back a lot of your gains for the afternoon scalping, and yet you scalp another 10 times to make it back. So I kind of just stopped doing that, and just mostly focusing on going with the trend of the trade. Unless it's going sideways, completely sideways, and then it's a wide range, then you trade both directions, right? But if it's like a tight range and it's kind of trending in one direction, then you always just go with the trend. If you know how to read internals, internals kind of tell you if it's going to be a trending day or a choppy day. I teach that in the advanced course. So yeah, in the course, like if you use the internals, you'll know like today was a trending day, but obviously majority of the trend was done at the beginning of the day, so the entire afternoon's kind of just drifted sideways, and that happens when you get an extended move like today. We had a huge gap up and then a huge move up, so it was at the upper price range of where it should be trading. So, it's very hard to make another big move after that once you already made like a 3% move for the SPX. So.
A quick question you might be able to address. Any reason you go for 30 delta, options as opposed to another, like a higher or lower delta?
Yeah, so I find that 30 delta is my sweet spot, because if you go at the money, you can go in it, but if it reverses on you, you're going to lose a lot of money really quickly, right? So with a 30 delta, if it reverses on me, I could cut the loss pretty quicker and smaller. But if it actually goes in my direction, you'll go in the money and you'll make just as much money. Just you'll be missing out just slightly on the profits if it actually goes in the trend, and then your contra will actually go from 30 delta to be like 50, 60, 70 delta, right?
So I understand why maybe theta might not matter as much for like these quicker scalps, but do you consider theta when swinging then?
Swinging like overnight?
Yeah.
Yeah, I don't hold overnight with stuff like that. If you do overnight swing trading, you have to have the right environment to do it. Right now is not the environment to swing overnight at all. And when it is, you want to use a 70 delta and about 60 days out.
Gotcha. Thank you.
Anybody have questions? Does everybody understand like how to use this? Like it's it's fairly simple, but if if you follow the exact rules to use this, you can be pretty profitable, right? Especially when you're just going to do that first 2-hour trade. As long as you apply your risk management, you're going to win way more than what you'll lose, right? You're going to have days where you're going to lose some money, but if you go back for the entire month, if you actually follow the plan, trading plan, you should be making like way more money than what you'd be losing on a bad day if you have the proper risk management, you follow the actual rules. Like just look through the rules in this slide. You follow everything on these slides here, you should do just fine, right? You should be able to make quite a bit of money day trading, especially when there's big volatility like the last week or so, right? Like the last few days, I did the calculations. If you just did one contract, just for the first 2 hours of every single day, your $2,000 would probably be worth about, somewhere around 30 or 40,000 with $2,000, right? And that's if you just do one contract. Just imagine you do like 3 to 5 contracts, or you use your profits from the first 2 days to scale up to 2 or 3 contracts. Well, you could have made like $100,000 just with that opening move. So it's really, you want to control your risk just like everything else, right? So as long as you control your risk properly, and then you let it ride with the trend when it's trending, you're gonna make a lot of money with this, right? Because especially with these 100-point days, these are your money makers. If you can make 100 points in a day, right, with the first 2 hours, you're basically just printing money, right? Because 100 points, that's one contract, that's about $10,000. So anybody want to share their experience using it so far, or have something that they see that with the algo that works a certain way, that or any tips on how to use it from your experience? So the stop loss line, once it crosses over, that's when it gives you that buy sell signal, Michael. So once it crosses, it'll give you this confirmation signal. That's where it comes from. Maybe I'll go through like a few trades from the past few days, and go through some of those 5-minute charts. Right. So this is on Thursday. This is a really good one. So at the open, so you can see like in pre-market, we get that flush down. You see how he flushes outside of the bands? Once he flushes outside the bands, you see the consolidation back into the band. So he just consolidates sideways. You see how big the doji candles are, the Heikin-Ashi candles are. Once you start seeing very tiny candles after very large candles, it tends to try to reverse, or it just consolidate and then continue down. So to trade these, one, you watch it to see if you break the low of this. If you break the low of this, most likely this is a bear flag, and then you'll trigger a sell signal, and you'll continue to go down. But if you start reversing, you see the ribbons start churning, and then you get the buy signal slightly after ribbon churns, right? And then that's when you start moving in the other direction. So if you caught that one move right here, you didn't get a sell signal to all the way up here. That's 16 points. That on the SPX, that's 170 points. 170 points, meaning one contract would have printed you about $17,000 on that trade if you caught the whole thing, right? And like that's the one trade that all you need is one of these trades a week, and you could make substantial amount of money throughout your time, right? So here, this is the day that was consolidation day, right? So if it's a consolidation day, usually what happens is if there's a really big update on the daily chart, the next day is usually a consolidation day. So when you're expecting a consolidation day, you want to know what's the range, right? So to know the range, you just measure the high and low after the first 30 minutes. So if you do that, that should around your low and high, this is your range. So every single time when it comes to the bottom of the range, you can buy it, and then you can sell on top of the range. So to trade these on the 5 minutes is not that great. But if I use the 1 minute, I'm just going to time. So if I do that right here with the 1 minute, right? The 1 minute times it exactly at the bottom as it changes, right? And then you get the sell signal somewhere around the upper range right here, right? And then as you get to the bottom of the range, it gives you buy sell signal at the upper range, buy signal, sell signal, right? On the 5 minute, it's a little too buy right here, sell right here, buy right here, sell right here. That would not make you much money, right? If you do that on the 5 minute, but because it's a very large range, the 1 minute would have printed you some serious money just trading back and forth the range, right? Because the distance from these are quite large, right? If you measure that from buy right here to the sell right here, that's $1.30. So $1.30, that's still like about 15 points, right? About 15 points, and like even because it's such a predictable range, 15 points gives you about $2 to $5, depending on the delta you're using per trade, right? And you could trade back and forth on these because it's the lower range, upper range, lower range, upper range, right? So when it's predictable, like lower range and upper range, you can make money with the 1 minute. It's not like a very tight range like today where it's lower highs, higher lows. So the range gets tighter and tighter and tighter. Those are the ones you want to avoid. But these horizontal consolidations, just like a predictable low, a predictable high, you can always trade those ones. So once you see it get a predicted low and high a couple of times, you pretty well can use that as your buy and sell areas for the day. So
Eddie, I noticed on the 5 minute, you'll notice like probably the second low.
this one,
No, left.
this one,
Left.
left.
So you have the buy signal, and then if you go maybe
This
like
one?
1, 2, 3, yeah, exactly that one. I noticed that the candle goes past the pressure bands,
Yeah.
and then on the 1 minute you got probably like a buy signal, or at least probably a hammer or
It's
something.
right here.
Yeah.
Yeah.
So that would probably give you a leading indicator, right? Where you're mentioning reversion to the mean, or
Yeah.
if in this case bouncing off the range. So like, I think if you combine those two things and what you taught us earlier, it's pretty deadly.
Yeah, that's what I mean. Like you want to use multiple time frames when you're trading always, right? So like I said, I have this algorithm on one monitor, and then I have the rigor chart on another monitor, so I can actually see what's going on. I need to see if there's a setup on the rigor candles, and then I could use the algorithm to see if there's any type of signals within that setup, right? So if I could combine the two, and then I'm also looking at, I'm looking at the 1 minute, the 5 minute, I'm looking at 15-second candles, right? And then you're looking at the hourly and the daily as well. So you kind of have a whole wide range. So what is the daily, right? What is the bias on the daily chart? If the bias on the daily chart is bullish, then really there's really no and the hourly is bullish, there's really no reason to try to short it, right? So if the 5 minute is trending up, even if it's extended, you wouldn't be shorting it. You'll be just waiting for it to pull back to go back in for another buy, right? So that's why you want to use multiple time frames and then just trade the trend, right?
So there's nothing, I guess. Well, let me ask you this way. So when I see that big candle go past the pressure band, right, and I'm like, okay, you know what? This might be a reversion to the mean off the bottom of the range. You can go in with a third position. Just obviously have a stop loss right outside of that range. And then on the buy signal, that would be your confirmation to go in half position again or whatever, right? Whatever you want, I guess.
Yeah, you can definitely do that. And I mean, it'll work a lot better if you have shares or futures.
Yeah.
Options may be a little bit harder, but yeah, you can definitely do that with shares. Shares would be super easy because you just set the stop at the low with your third position. And then if you get a buy signal, you add on to it, and then you just raise your stop to break even, right? So,
okay.
Yeah.
Cool. Thanks.
Yeah, you guys all doing like with shares with this system, super easy because you can use a hard stop, right? But with options, it's a little bit harder. So with options, you want to take your profits a little bit quicker. With shares, you can actually ride the entire trend. Shares, futures, you can ride the entire trend all the way up, right? It's just with options, if you get one of these very sharp candles, that sell signal won't come on till the candle breaks the low of that candle. So if you bought right here and then you made a bunch of money, this one candle wipe out half your profits. right? So when you see it start breaking above like the bands, you want to start taking profits, right? And then scale up at least half, right? And then leave some on there, and then we start going down a little bit more, scale a little bit more, and then if you get a sell center, you want to go fully out, right? So you really have to have a plan on how you want to trade, depending what you're trading, right? Because a person trading shares and a person trading options, even though they're using the same chart, it will be different risk management, right? So if you're doing it with options, you want to manage the risk a little bit better, right? You want to exit a little bit earlier. Don't try to be greedy, because greed with options can really hurt your portfolio. I know, right? So yeah, so if you're trading with options, you want to take profits a little bit earlier. You want to scale out of your trades. So every single certain amount of profit that you're willing to take, you take some off and you let it ride, right? That's what I normally do with options. But if you have shares, you don't really need to worry about it, because you can just keep raising your stops. Same with futures, you just keep raising your stops. And just let it ride till you get stopped out, or till the sell signal comes on. Or if one of the other warning signals come on, then you can just scale out your trade, right? So it's easy to do it that way. If you guys are selling spreads, wait for like a buy signal near support. Then you can sell your in the money, at the money spreads, right? Or you can sell your out of money, whatever you want, right? So that's what you will be looking for, is signals at near support or resistance areas, because you're not making scalps, you're not making big, you can't make much money with small tiny moves. You need a much bigger move to decay faster, especially with those in the money spreads, right? So you need to go in at a support area where it's a high potential for a bigger bounce. That's the only time you want to sell a spread at, with the signals, right? But if you're trading options, you can always just scalp these type of moves, like right here. You can scalp these, right? If you're selling options, you can probably do at the lower part right here too. You have to wait till we actually come all the way back down to the lower part, then you can sell your spreads, right? If it's predictable that way. So if it's like trending, say it's trending right here, these would be the area where you would want to, when you get the big moves and then you get the ribbon expansion with the volume, those will be the area where you want to sell like in the money. If the move has already been made and it start reversing down, you can still sell spreads here, but I wouldn't sell them in the money here, just in case you'll get the reversal back down, because one, this is an extended move, right? Once you get an extended move, you can have the extended pullback too. So it pulls back about half, 50% or 61.8%. So if it actually pulls back to 60% and start getting a buy signal, you can actually sell a spread at that time. So it has to be like a more of a high probability bounce area to sell spreads. You're not really looking for these small moves to sell spreads, but you can definitely scalp these small moves, especially with shares. You could trade these small moves like 10 points. 10 points on the shares is about 10 cents on the SPY or TQQQ. So if you could have 1,000 or 2,000 shares, you can scalp those 10 20 cents all day long, like multiple times in the day. It wouldn't be much work. So and it just, at the end of the day, it just adds up to a pretty big number. So at least that's what I used to do.
Eddie, is there a time when you would use the 15-second candle in this?
Yes. I still use 15 seconds, but not with the algorithm, but with just a regular candle.
Right. I mean with this. With
this. Yeah. I find that 15 seconds gives too much false signals.
Yeah. Okay.
Yeah, like way too much. That's why I only use the 1 minute on this, because you need a bigger move with it, because it's, one, is Heikin-Ashi, and two, the buy signals are usually confirmation candles, meaning 2 or 3 candles into the trend already, right? So with the 15 seconds, if it's 2 or 3 candles already in it, there's not a lot of run room for a scalp like that. So because it'll give you like a warning signal, like literally a little bit later, and the range is just too small for it.
With this afternoon, the way it chopped around, was there anything there that you would
Yeah.
have jumped, like I didn't trade this afternoon at all. I did it
Mhm.
all this morning, but is there anything there that you would have done with shares?
Shares, like that chop, let me look at chart for a second. I got to see what TQQ was, like what was the range. If there's a range of at least 20 cents, then you can definitely scalp it. But if it's not, if it's just like a 10-cent range, then maybe not. Okay, so that's today right here. Yeah, so it was this chop right here, right? So let's see, what was the range on that? Yeah, it's about 20 cents. You can scalp 10 or 15 cents. If you're trading over 1,000 shares, that's doable. Other than that, it's not doable.
Yeah.
Right. Because the range is just too small. Like, yeah, like I was trying to do with options and it was just way too small. I just keep exiting with like 30 cents or 50 cents. I forget what it was that I made off that tiny little move, but yeah, it wasn't a lot that you could have made on there. So
Okay.
your move would have been like right here, right here, right here. That's it.
Yeah, that's what I did this morning.
Yeah, first 2 hours. That's all you really need. You don't have to trade the whole day.
Yep.
You know what happens in the afternoons, so right. So like if you make if you hit your goal the first 2 hours, and then well, I mean, you could like give it another hour in the afternoon to see if there's any type of range being developed. If it was a bigger size range, then you can definitely trade it. But it was like a range like today where it was just like 20 cents. You might as well take the afternoon off and do nothing, right? So and go golf or something, right? So
I should have. Yeah, right.
yeah. Yeah. So yeah, so you know, you have to realize what type of day it is. Especially, I find that every single time when the pre-market makes a big gap move and it just stays up and not being gap filled, there's really no trades like that. Like it usually consolidates in a pretty tight range. Like I seen it in the past month. It happened multiple times already, right? Where you get like barely any movement after the first hour or so. So that's the type of day it was today too. It was all the move was made pre-market, and then you could have caught this, and this, and that was pretty well it. That's the first 2 hours. That was done. And today, like the internals were super strong, so I knew we weren't going to gap filled either. So, right. And the thing like this morning was that like 20 times the volt was 20 times. It's not going to gap fill at all with that. So.
Hey Eddie, can you show how to set up an alerts for the buy and sell signals?
Oh yeah, really easy. You just right click, add alert. That's it. That's it.
Gotcha. Okay, because I set up the alerts and it's giving me alerts for like the you know the little triangles also, but I was just
yeah. So if you click on the alert type right here, you could click on buy or sell or buy sell.
Okay.
So if you're just looking for buy sell, you click on buy sell, and if you want it more than once, you just put once per minute. And whatever time frame you set that is the time frame you'll trigger.
Okay, gotcha. Thank you.
No problem. Yeah, yeah. So if you're not watching, that's a good way to do it. It's just use it, especially if you're watching two different charts. You can set that way. You'll keep the alert on all the charts that you're watching. So. Anybody else have questions?
I think somebody's got a question about your indicator menu. Somebody joined after the intro.
Oh, sorry. Forgot to read the chat. My indicator. Now there's only two. It's just pressure bands and the day trend algo. That's the two. The new one's just two. I put them all into one so it saves you space on your trading view. Since trading view the plans they give you a limited amount of indicators, so I just kind of make them less. Oh, you enter right away, Shaggy. If you're looking to enter, you enter at the buy signal right away on the 1 minute. But you, like I said, you want to use the technicals with the indication. So if it looks good on the chart, like your candlestick chart, and then you get a buy signal, that's a higher probability trade. But say that yeah, on the chart itself, it's like below the moving averages is in a downtrend, but it gives you a buy signal on the algorithm, then maybe you want to take a closer look to see if you'll go back above the moving averages, because sometimes it will give you a false signal, especially when when the trend is about to change from bullish to bearish or bearish to bullish. Then it kind of the signals will start reversing on you. So you can use this on the hourly. On the daily, you wouldn't want to use this on the daily because I adjusted the algo to only do day trading. So if you do it on the daily, you'll get a bunch of false signals. I mean, you can still capture some money on the daily, but it would not work as good. You actually make some adjustments if you want to do it on the daily.
Hey, Eddie, what kind of back testing did you do on this? I know it works fairly well in this market, but have you tried any other markets?
Yeah, so you can use this for swing trading too. So if you're using it during volatility times, it'll work really, really well. If you use it on high volume stocks, it'll work really, really well. Anything that moves, it'll work well. Futures works good, Forex works good. And if you once the volatility dies, you kind of have to find stocks that move to make it work well.
So your gap and go, your gap and fill, momentum stocks, things like that.
Yeah, well, anything with a range that it moves in, then you'll be good, because you're looking for a certain percentage in a day, right, of movement. So if say the SPX start going back to normal, like we're in the bull market, the SPX literally in the entire day moves like 20 points, right? So you wouldn't be trading SPX per se. You can probably still trade TQQQ or whatever because it's 3 times leverage, but you'll be better off trading something that moves a lot in a day. So you'll be doing pre-market scans for high volume trades. You can do like anybody that has earnings. Those are the stocks that you can trade because those tend to have big moves after it opens. Anything with some kind of catalyst, stocks that has catalyst, you can trade, or anything that has a big daily range, you can trade. Something like a Tesla, you can trade. Yeah, even any big stock that moves quite a bit in dollar wise, you can trade if you're looking for options. But yeah, you can do it on anything that moves, that pretty much. Anything with volume, anything that moves, you can use this algorithm with. If you adjust like a little bit, you can use it on a daily chart too. Let's take a look if we use it on daily, see what happens. So this is the daily. Yeah, you can still, like, even with the certain the current settings, you can still capture fairly good moves, like buy right here, sell here. You would have captured an entire up move right there. You would capture a pretty good down move right here. Right here is where the algos start not working that well, is when, because the movement's too big. The stop range is too small for it, because for a daily chart you need a bigger stop range. For day trading, you just need a smaller stop range because it doesn't move that much in a day per candle, right? right? So it works better for day trading, but if you wanted to use it for swing trading, you kind of need to adjust your stop range to be a little bit bigger, so that it doesn't give you these more of these false signals right here. So, but even that, you could capture some pretty good moves right here, like, right? As long as you follow the same direction. When you're in the uptrend, you're only looking for bull buys. When you're in a downtrend, you're only looking for sells. You're going with the trend. If that happens, you will capture this big move right here, this move right here, and then these moves right here, right? So it still works pretty good. So does everybody understand how to use this? Any more questions? Anything you don't understand? All good?
Eddie,
Yeah.
I saw a yellow X on one of your 1 minute charts.
Oh, yeah, no.
Sorry if you've gone through this. I missed the first
No,
half.
that's just that's nothing. That's just something else I was testing. These are old indicators.
Okay.
Yeah, I was just playing around with the what looks better on the chart. Yeah. Yeah, it's just using like some of the older because it already has 9 indicators, but I took them off, so it's basically this, right? So it's basically just the yellow and in these arrows right here. I was using the X to replace that. So
Last one for me. Again, sorry, I missed the first half of this, so I apologize if I've gone through this. But the way I used it today was I jumped in using the 1 minute and I exited it using the 5 minutes.
yeah, that works.
Good, bad.
Yeah, that works. Because the 5 minutes basically the overall trend, like the bigger trend. So the 5 minute is one that really matters. The 1 minute, like even if the 1 minute probably took made you exit right here because there's a little consolidation. So you do get a quicker exit if you don't want to hold it for that long. So it really depends on how you're trading, right? And because you're using shares, you can actually use the full 5 minutes because all you're doing is you're racing your stops anyway, right? So it's not really going to give back too much of your gains. Your wins will be much bigger than your losses with shares. So it's just when you're using options, you really want to take like a slightly earlier exit because that pullback right there, you're giving back half your gains on your option premium. So yeah.
Okay, thanks.
Eddie, I apologize if I also missed the very beginning, but I just want to make sure that I understand that the difference and the importance or the relevance of the flags, triangles. I understand the dots. Yeah, if you could just go over that. Thank you.
Okay, so it's in the slide. So basically the flags is when the price goes above the pressure bands. So once it goes like outside the pressure bands, you get the flags. So with the flags, it's measuring volatility. So it just tells you that it was a aggressive move. But after a big aggressive momentum move, what happens, right? Momentum dies. When it dies, what does it do? It reverts back to the mean. So basically, when you see the flags, there's a chance that you'll revert back into the mean like it does right here. You just consolidate back into the mean, and then it'll go again, right? So that's all the flag does. The little triangles are just reversal indicators. So it's a potential reversal, but it's not quite. So these are low probability reversals. This calculates overbought. It's basically telling you that right here is slightly overbought. That's what it's saying, right? And the yellow ones are a little bit higher probability of reversals. Is the yellow dots. And the yellow candles is also reversal candles as well. So if you're trading, you're basically using here. It probably looks better on the 1 minute chart. So if you're trading, you're basically looking for the yellow dot and the yellow circle, yellow candles as put early indication of reversal, and then you use the sell signal to confirm the reversal. So sometimes you'll get the yellow dot and the yellow candles, and all it's going to do is like pulls back into a moving average, and then it continues higher. So you won't get the sell signal, right? But what I do is, if I am in this trade right here, and then I got up to here and I see the yellow dot, well, I'm taking profits, right? I'm using this as an early indication for me to take some profits, especially if you're trading options, right? Because with options, like I said, this pullback from here to here, you're losing about half before you get half your profits before you get sell signal. So you want to take the early exit. Once you see the dot, you want to trim at least half or trim 2/3 and then leave some running. But if I have a move like this, I'm probably going to take it all off right here as soon as I see the yellow candle, right? So in the ribbons right here, the ribbons are momentum ribbons. So if the momentum is strong, the ribbon will stay like this and it'll expand, right? But once the momentum starts slowing down, it's going to start rolling over. So you can use the rollover as your potential exit point as well.
Got it. Thanks, Eddie.
No problem.
Looks like Shaggy asked a question related to that.
So it's two different algorithms. So it's two very different calculations. I did like a certain way to calculate the circle, and I did a certain way to calculate the trend reversal of the candles. The candles is basically breaking the low of the previous average of the previous 6 candles, so it turns yellow. So I'm using the candle size and the candle movement to measure the candle reversal, potential reversal. And the circle is based off a whole different calculation that I use on volume and price to give an indication of a reversal. So it's more of a combination of a few different indicators into one to give me the signal. So it'll tell me when it's overbought, when it's about to reverse, and then when it actually confirms the reversal. That's basically what the entire algorithm is, right? So I got the early indication telling me that it's overbought, and then I got the early indication saying it's about to reverse, and then I have the confirmation candle of it actually reversing, which creates a much higher probability area when you got all of them at the same area. So like right here, you got the it's outside. So you got the flag, and then you have the dot, and then you have the sell signal plus an arrow, right? So all 3 areas are pointing to are matching into a reversal. So that gives you a much higher probability of a reversal, because you can see that was a big move, right? So that tells me that that was a high conviction reversal area, right? And then this one here, it ran up really strong, and then you get the yellow dot for early indication, but you didn't even get the sell signal till about 5-6 candles in, right? So if you knew that this was an early reversal indicator, you can actually start taking profits right here, and then you can wait for the sell signal to get rid of the rest of it, right? But sometimes like you get this, and then you don't get the sell signal, and just continues higher. So you just trim half, and then you still be able to ride the rest of it, right? So that's kind of how I use it. It's more of a trading system for how I trade. So you once you know how it works, you can probably adjust it to your own trading style and use the indicators for different other reasons than mine, right? So I use it as an early exit, but you can use it like if you're doing with shares or something, you can actually use it like a potential area where you'll reverse back, and then you can add or something, right? So it really up to what your trading style is and how you want to process that information.
Eddie, what's the significance of the size of the yellow candle? I know some of them are bigger.
Yeah, it just tells you the volatility. When you have a big candle, that means there's very high volatility. So when you get this very small candles, that means volatility is dying. Okay. So when it's rising, you want to see bigger candles as they rise. When you get big candles rising, and then all of a sudden you start getting smaller and smaller candles, you want to take that's an early hint that it's going to reverse soon.
Got it.
Yeah. So I always take like some off once I see like, especially with Heiken Ashes. When you get Heiken Ashes, that when it's rising, the bottom is flat. That's how we know it's a strong move, strong uptrend. But once you start seeing little wicks at the bottom, it's potential reversals. That means that the bears should start fighting the trend, right? Because it processes 6 candles prior to that to calculate the Heikin Ashi candle.
Oh, that's good. Okay.
Yeah. So like you can see right here, like these are big candles, they're flat, and then it's getting smaller and smaller. And then all of a sudden you can start getting these dojis or whatever from the top. And then it tried to reverse and then it start going flat again, right? So. We're all good? We're all good. We're going to call it a night. Any more questions? All right.
Thanks, Eddie.
Thanks, Eddie.
I'll see you guys.
Yeah, thanks again for that, Eddie.
Yeah, thank you very much.
Thanks,
Great
Eddie.
night.
Awesome session. Thank you.
No problem. Hope you guys make some money. See you guys tomorrow.